Hey guys, welcome back to my channel. It's been a while since I've made my last video, and today I'm going to talk about a different company. It's called Talkspace Inc. Uh, it is trading under NASDAQ under the ticker symbol TALK. And today I'm going to do a systematic, rational approach in analyzing this company. I'll look at its fundamental metrics, its financial metrics, its management alignment, the risk reward profile, and in the end of the video, I'll let you know if it is a buy, hold, or a sell for me. I'm Jordan Taylor, an individual investor, and without wasting any time, let's go ahead. So, what does the company do? Primarily, Talkspace is an online mental health service provider, um, and within Talkspace platform, it has access to licensed therapist. It can get you one in 2 days. It can provide therapy sessions over video, voice, or live chat, including your mobile phone. Um, you can do unlimited messaging with your therapist 24/7. You can switch therapist at any time at no cost, and it can also provide between session support with um, Talkspace, Talkspace personalized podcasts. Um, but individual features can vary by insurance coverage as well. And the services that they provide are they include therapy, medications, and treatments. Under therapy services, they provide individual therapy, couples therapy, LGBTQIA therapy, therapy for women, military, veterans, seniors, for teenagers, um, and AI supported therapy as well. I got all this information from Talkspace website, so it is available there for anyone to access, and it's free of cost. It's a simple business. We don't need to overcomplicate things. Um, it is a mental health online mental health service provider. It is a relatively new industry, and this industry has been mm, booming after the COVID-19 pandemic. And Talkspace is the leader right now in this um, sector. So under medications, I have further information for you here. Under medications, they provide a lot of these mental health related medications. They don't provide it itself, but they partner with other companies to do that. And under treatments, these they can provide treatment for anxiety, social anxiety, depression, bipolar disorder, insomnia, PTSD, ADHD, postpartum depression, panic disorder, gambling addiction, all sorts of mental health issues. um, so their medications, they have partnered with Amazon Pharmacy. So you can get medication through Talkspace, and that they can be delivered at your door fast and free with Amazon Pharmacy. So they have this sort of partnership with Amazon Pharmacy to provide you with the medications as well. So these are the primary services that they provide. So let's look at the stock chart. I love this um, chart. I love to go over the stock chart performance over the period of time. So let's look at their performance over the maximum time period when they went public in 2021. Um, they went public as a SPAC. So they merged with a blank check company, and that's how they became public. And you can see that initially in 2021 they were trading at around $12, like maximum I think they went was around 12 dollars per share, and from there it is a continuous decline. It was a continuous decline up until 2023, and from 2023 they have regained a little bit of momentum, not a lot but a little bit of momentum. Overall, over the course of this period from 2021 to 2026, January 2026, they are down 69%. If we look at year to date in 2025, I took this screenshots towards the end of 2025 when the stock was trading at out 3.07, and I think right now at the time of me making this video on January 4, I think the stock is trading around 3.5. So not too high from 3.07, but it is slightly high than this screenshot right here. So over in 2025 year to date at the end of December, close to the end of December, it was down 0.65%. So relatively, like there were fluctuations up and down, but almost relatively flat, I would say. So at this price of 3.07, their market cap is around $500 million. The revenue is $214 million, trailing 12 months, and net income trailing 12 months is 4.24 million. So they're making money. The price to earning ratio, crazy, crazy, crazy expensive. 121.51. So if you look at the price to earnings ratio alone, and if you don't look at the other metrics, then you might think that this company is, wow, this is expensive, and you might just want to avoid it. But there's a lot of metrics beyond price to earning ratio that you need to look into while researching a company. That's why I made this video. So if you look at the forward price to earning ratio, it is 32.32. So closer to, let's say, S&P 500's price to earning ratio right now. So but this is forward looking metrics, and it is based on the forecast. But wow, it is really low compared to its current price to earning ratio. So we will go deeper into this company as we go through the presentation, and I'll give you my thesis as to why I think the company, if I think the company is overvalued or undervalued. So the 52-week range was 2.2 to 4.3. Analysts are giving it a strong buy, and I think they have a price target of around $4.5 on average. The price goes as high as $6 and as low as I think 3.5 or something like that. um, yeah, the average price target is 5.13. You can see here the beta is 1.21, so it is a little bit volatile stock compared to S&P 500. And for me personally, I think it is one of the multi-baggers in the making. um, this is a relatively new industry. Nobody in the finance industry is talking about Talkspace. They're saying that it is a penny stock. You saw Talkspace and look at the news, and these analysts or these online articles um, say that Talkspace has a lot of potential, but they brand it as a penny stock, and I think it is misunderstood as of now. I don't know how long it will take. It might take 1 or 2 years, but I think this stock has, or this company has, a lot of upside potential, and I think it is executing in the right direction um, to make it a potential multi-bagger. So let's go ahead and look at the company. So uh, let's look at its financial analysis. Let's start with the income statement. Over the course of 5 years, you can see its revenue. It has been increasing steadily, and it is improving a lot. So you can see in 2021 it was closer to 25 million. Now per quarter it is around 59 million, and over the last trailing 12 months it was 214 million. So its revenue has been increasing steadily over the course of time. Uh, the other thing that has happened over the course of 5 years time period, its selling, general, and admin cost has gone down. It is very rare to see this in a growing company like this. Like, it is growing at a CAGR of around 17 to 25%. And basically it is bringing down the cost of the operations down, which is pretty great to see in a company like this, like the company which is growing at double digits, improving its margins and everything, bringing down its general and admin cost down is it is an awesome execution from what I see happening right here. You can see its operating expenses, they are coming down as well, and they have come down a lot from 2021. So what the company basically is doing is it is increasing its revenue and at the same time reducing its cost. So what is happening? Its margin is improving, its net cash flow is improving, its net income is improving. So all those sorts of shenanigans. So if we look at the gross profit, it is going up. Pre-tax income, it was negative up until 2023, and from 2024 it has already turned positive, and it has improved a lot. Like in 2022 it was l- like losing $75 million per year. Now it is making $4.4 million. So that's a lot of improvement. Net income, the same. not a big difference between pre-tax income and net income, because it doesn't have any other expensive expenses. Uh, like so net income has improved significantly, and if we look at their earning before interest and taxes, you can see that it has turned positive as well. So a lot of improvement in this company if we look at the income statement. So if we look at their looking at their shares outstanding or diluted share outstanding, so you can see they have almost stayed the same from around, let's say, 2023. Like it has increased significantly compared to 2020. There's a lot of new shares that was issued from 2020 if you look at 2020, but from 20 around 2023, it has stayed relatively um, flat, or like it has increased by single digits, let's say, not too crazy. And if we look at the earning per share metrics, you can see that it was negative up until 2023 and it turned positive in 2024. And looking at the trailing 12 months, it has come up to 0.03 um, per share. So finally the company has turned positive in 2024. And looking at their free cash flow, it has improved a lot as well. It turned positive in 2024 and the momentum is going on. There's a slight dip in trailing 12 months, but there's a reason for it, but still it is moving in the right direction. So looking at the balance sheet, let's analyze their balance sheet. Their cash and short-term investments, it has been coming down. So their cash position is coming down. We'll need to figure out where this cash is going. Their current assets is coming down. The company is becoming less and less capital intensive. It's an online mental health service provider, so it doesn't need too much of physical infrastructure. I think which is good. Like there's no reason to panic seeing the current assets coming down for a company like Talkspace. If it can optimize its operations uh, going online, then fair, because it doesn't need physical office or like too much of physical infrastructure or like too much of assets to run the company. The total assets have been coming down as well, 129 millions, and the current liabilities is coming down as well. So if you look at their total current assets, which are sitting at around 114 million dollars, and compare it to the current liabilities, which is around 19.38 million, so the current liabilities are very less compared to their current assets. If we look at the total liabilities, it is only 19.96 million, so not a big difference from their current liabilities. So this what this basically means is that company doesn't have any debt, long-term debt. And if we look at their shareholders equity, it is coming down. Although ideally I would like to see it going up, um, but you can't get a perfect company anywhere, I think. But yeah, the shareholders equity is $109 million, and their uh, net cash or debt is $91 million. Like the company has no debt, so all it has is cash, and you can see the cash position is coming down, but it is still $91.61 million. So this is a company that has no debt, no long-term debt, has a cash position of $91 million, and has a lot of assets compared to their liabilities. We'll talk about that later, in a later part of the video. So let's look at their cash flow statement. You can see their depreciation and amortization. It was coming down up until 2024, but you can see there's a spike in trailing 12 months. So not a big difference, but it has recently been starting to go up. Operating cash flow. So the cash from operations, the cash that the company is making from operations, it has improved a lot. In 2024 it started making money. Before that it was losing money, and in 2025, trailing 12 months, it is still making money, albeit a little less than 2024. Their investing cash flow, that is coming down. So the company is um, um, not making money, but it is investing a lot of its cash, you can say, from this metric. And stock based compensation, I like this metric a lot for this company. It has came down a lot, and it has stayed relatively flat from 2023. This is what we like in companies. uh, a lot of growing companies, early companies, with high CAGR. There's a lot of investor um, worth that gets eroded due to stock-based compensation, but not for Talkspace. And that's one of the major reasons why I like this company, because the company is improving its revenue, its net income, its cash flows, and all sort of stuff. It is decreasing its cost, general cost, administrative costs, its operating costs, and at the same time, it is not burning all the money as stock-based compensation. um, so it is not issuing unnecessary shares, or it is not diluting you as an investor. So that's why I like this company. um, its net cash flow, you can see it is not positive. um, so the company has been like losing money if we look at only its net cash flow, but there's a reason why it is happening, and it is due to one, it is due to share buyback program that this company has initiated in 2024, and it was continued up until 2025 as well. And the other one is it is doing a lot of M&A deals and acquiring other companies as well. So it is um, deploying that cash to grow the company. So um, even though the cash flow is like quarter over quarter, it is declining. Net cash flow, its overall cash position is still positive. The company still has a lot of cash. But if you look at the free cash flow, that is the operating cash flow minus the capex, you can see that the company has turned positive, and it is bringing in a lot more cash than it is expending. So this is really good to see. So let's look at some key ratios. So if we look at the price to earning ratio, like I mentioned early in the video, it is like crazy high. It was close to around 500 PE earlier in 2024, but now it has come down significantly to 138. But still, if you look at PE only, this company is really, really expensive. But if we look at forward PE, it used to be around 160, 170 in 2024, and now it has come down significantly to 33. So, what is happening? The company is growing rapidly, so that is causing its forward PE to decline a lot. So, the growth is just immense for this company. So enterprise valuation to sales ratio, EV to sales ratio, it has come down a lot from 2021. Um, has stayed stable from around 2024, stayed sitting at 2.28. So fairly fair value, I would say. Not too expensive, not too expensive. But if we look at their return on equity, uh, it was negative for a long, long time, and I think in 2024 it turned positive. It is almost negligible looking at this bar here, but for the recent quarter, I I think this metrics is on a quarterly basis, or am I wrong here? No, huh, I'm not sure. But yeah, it is 11.71 percentage in the last quarter. Yeah, this is quarterly basis. Sorry. So looking at the quarterly basis, you can see the return on equity that has turned positive in current quarter, and earlier it was negative, let's say in 2024, and like earlier than 2024. Return on assets, it was negative for a long, long time, and now it is positive. Return on capital, invested capital, it was negative for a long, long time. Now the company is positive. And return on capital employed, ROCE, it was negative, and the company is now positive. So the company has made um, right decisions in the right direction to make all these metrics positive, which is great. So let's look at the financial position or health of the company. Its current ratio, which is the ratio of current assets to current liabilities, it is 5.91, 114 million of current assets divided by 19.38 million of current liabilities. So almost six. It is great. It is great. So if we look at the quick ratio, which is the ratio of cash plus short-term investments plus account receivable divided by current liabilities, it is 106 million divided by 19 million, which is 5.5, which is great as well. So, and debt to equity ratio, it is not available because they have zero debt. Um, so the company is extremely solvent because it has no short-term debts, it was no long-term debt, and debt obligations are virtually non-existent for this company. So this company is, it does not have any obligations for other entities like this. Like when a company doesn't have any debt, it is a great position to be in. I cannot stress how much of a great position it is to be in, because you don't need to rely on other things. Like you can only focus on your company, you can focus on execution, you don't have to stress about paying interest, and you can just ignore all the other things and you can just focus on improving the company. Let's say, like, I'll give you an example here. So high interest rate environment, like which we are currently in, although it has declined significantly from 2024, but still the rates are high, right? It won't have any material effect on this company because it doesn't have any debt. It doesn't have any debtors. It doesn't need to pay any debt. But if you look at other companies that are utilizing debt to grow, they have to pay a lot of interest. So let's look at the competitors like BetterHelp. Like it is one of the major competitors of Talkspace. It is owned by Teladoc. So Teladoc, um, its ticker symbol is TDOC. You can look it up for yourselves. But they are annually paying around 21 million in interest expense every year. So that is a lot of money that is going out of um, their net income just on the interest. But that doesn't apply to Talkspace. So it is extremely solvent, which I like a lot about this company. But let's look at the company's valuation. Um, Not having debt or having a good financial position doesn't mean that the company is cheap, right? So let's look at the price to earning ratio. So it is 143.85. That is, if you are a person who looks at the price to earning ratio, this is way overvalued. Like if I look this company only from price to earning ratio, I wouldn't touch this company with a 10-foot pole. Mm, my immediate consensus or immediate decision would be not to buy. But let's look at other factors. So its EPS, earning per share, in trailing 12 months was 0.03, and EPS growth was 200% from last year. So that's a lot of growth, guys. That's a lot of growth. So using this earning per share, let's look at the company's price to earning growth. Because for a company like Talkspace, which has recently gone net income positive, looking at price to earning alone, I think, does not justify its valuation. It might be, price to earning might mislead you. So let's look at the analysts' forecast. So for the next year, the analysts are forecasting 249%. So let's not be like as optimistic as the analyst, because most of the time, sometimes they can get things wrong, right? So let's reduce it to. I want to be on the conservative side. Let's reduce it to 175%. And EPS growth for the next 5 years, the analysts are forecasting at 179%. So let's reduce that to 100%. And using the other above assumption, so price to earning growth ratio according to next year's EPS growth, like according to analysts. So the price to earning ratio is 143.85, which is right here. And if you divide it by the earning per share growth, which is 249%, it is zero point 0.5, which is extremely cheap. Even assuming the conservative scenario of EPS growth of 175%, price to earning growth ratio is 0.82. So, looking at the price to earning growth, my consensus is that the company is seriously undervalued. So you can look at the importance of price to earning growth, and you can look at other big companies like Nvidia, or like say Apple, or um, Palantir. Let's not even talk about Palantir, right? But look at all those big companies. There's price to earning growth ratio is uh, 2, 3, or sometimes 7, 8, right? Some of these companies that are really overvalued, they have really high price to earning growth ratio. But especially if you are looking at price to earning growth, anything below 1 is considered good, and anything above 1 is considered overvaluation, right? So for a company like Talkspace that is growing rapidly with double digit growth, like 20%, 25%, um, uh, having a PEZ of, let's say, in between zero point 0.5 and 0.82 is, I think it is a bargain at this price level. So for me personally, I don't rely only on price to earning ratio. um, Looking at the price to earning growth, I think it is a buy at the current price level of 3.5. But I already own shares in Talkspace, full disclosure, and I have bought it as at around 2.8. I have my position at a much lower price. So if I'll give my decision later in the video, but let's go ahead. So let's look at the facts here. Talkspace has EPS growth of 260% from 2024 to 2025. TTM like rolling 12 for 2025, because they are yet to report Q4 earnings. So you can see here, earning per share, it was negative greater than 1, or let's say negative 1.5 in 2020. Like huge improvement by the time they were in 2023. And in 2024 it was 0.01, and trailing 12 months it is 0.03. So since the price to earning growth ratio is below 1, it indicates that for every dollar that you are investing in this company today will return you more than a dollar in coming year. So Peter Lynch has famously said, like, if you found a company below a PEG of zero point 0.1, you found yourself a bargain. So if you follow Peter Lynch, if you have read his book, there's a specific metric that Peter Lynch used to um decide on whether to buy or not buy a company, and price to earning growth was one of his favorite metrics. And um, that's what he had to say about price to earning growth. So every investor is different. You might look at other things, but for a company like Talkspace, I like to look at price to earning growth ratio. What is Talkspace doing recently? Let's look at the news. Let's look at their investor relation page. Let's look what the company is doing in recent quarters, and let's try to figure out what it is doing. Right. So what happened to Talkspace was about a year ago. Talkspace switched its business from consumer-based revenue to payer-based revenue. So before, Talkspace used to provide these online mental health therapy sessions, but consumers used to pay the company out of pocket. However, now Talkspace partners with these health insurance providers, and these health insurance providers um, pay the money to Talkspace. Like the consumers are they have a coverage with their health insurance providers. So if they take therapy sessions with Talkspace, um, Talkspace basically bills their insurance companies, and insurance companies pay out the money to Talkspace. So the consumers don't have to pay out of pocket money. So this has resulted in a major shift in how we look at Talkspace as a business, um, but also how the metrics are turning in Talkspace's favor, I would say. So instead of personal payment by individuals, insurance companies make payment of mental health therapy sessions for Talkspace, right? So this is a screenshot I took from their investor relation page. This is from Q3 earnings, Q3 2025 earnings. You can find it online. I'll post the link in the description below, where you can find these presentations. But let's look at this presentation. So you can see that on the left, on the y-axis, there's a dollar amount. And on the x-axis, there's Q3 2024 and Q3 2025, a comparison between Q3 2024 and Q3 2025. So what they are comparing is they are comparing the revenue composition. So in Q3 2024, payer revenue was $32 million. Come 2025, so that payer revenue has increased significantly from 32 to $45.5 million. So a lot of the revenue that is coming to Talkspace is through health insurance providers, right? But if we look at their consumer section revenue, so in 2024 it was $6 million, and in 2025 it is $4.6 million. So uh, it has decreased. So earlier, like I mentioned, people used to get these mental health therapy sessions from Talkspace, and they used to pay out of pocket. So that side of revenue is declining, declining from from for last quarter it was like from 6 million in 2024 to 4.6 million in 2025. However, a majority of the business now, or the revenue now, it's generated from the payer side, so through health insurance companies, right? That is a major shift in the company's strategy, its execution, and its business strategy, I would say. so so what has changed due to this transition from, let's say, this consumer based system to their peer based system? One difference we saw from their last quarter, from quarter 3 earnings, was their adjusted gross profit and percentage margin, right? um, so their gross profit has increased like from $21.7 million to $24.6 million. So it is increasing the gross profit. However, their percentage margin has declined from 45.8% to 41.5%. So I have this chart over here as well. You can see from 2020, it has been decreasing steadily. So their gross margin is decreasing. So like looking at this, someone might wonder, I think, like any rational person would think that, I think this is bad for company. You especially don't want your company's gross margins to come down, and because that doesn't spell good for the company either. There's like fierce competition, um, um, which because of why you might need to bring down your margins to stay competitive in the marketplace, or there might not be enough demand, right, for your services, and you might just want to give it at a cheaper price just so that you still get the revenue. However, this story is completely different. Like, this can people might be misled if they look only at this graph here, because you have seen like their overall revenue has increased a lot. So what this company is doing is they are sacrificing their margin, which is not like crazy decrease, but they are sacrificing their margins, but at the same time they are increasing the sales. So if they can get to a lot of people by sacrificing their margins, it makes a lot of sense. Because like it's common sense, right? If you are charging a lot to the consumer is not willing to use the service, because mental health service is really expensive. Just go online and try to find a mental health service provider. Like is therapy sessions will like sometimes these therapy sessions might cost you hundreds of dollars. um, but if you are switching from this consumer based to health insurance based pay model or payer model, or B2B model, um, there might be your margins might be compressed. However, people are more likely to use the service, right? So that's what this company is thinking all about now. Mm, its margin have shrunk, there's no doubt, but what it is doing is it is creating a majority of the market share, and its consumer base, it is just improving like outrageously. So there's a lot of like millions of people are joining Talkspace now. So so the company at the end of the day, it will make a lot of money just because a lot of people will use its services. So that's what the company is doing. So what else is Talkspace doing? So it is using artificial intelligence to streamline the operations within the company, but it is also using that to match the therapist with customers and utilize it is utilizing it for peer support. So one of the news about peer support was from October 6, 2025. It acquired Wish Health to expand AI-based social health and peer support solutions. So if you just go online and check Wish Health, it has like really good ratings. People just love using Wish Health who have used it before. So now Talkspace has acquired it. So these are all the news from 2025. So it has announced new in-network partnership with Blue Cross of Idaho. It is a health insurance provider. So Talkspace is going out and it is doing these deals, like massive deals with these insurance companies, saying that hey, we have this online mental health service, like we are these online mental health service providers, and how about you and I partner and we offer this mental health, like we have this coverage for mental health for your for the person who is using your insurance, right? And if they use it, um, we'll just bill you. And the companies are saying, well, yeah, I think so. Yeah, let's go ahead. Let's do a partnership, right? So yeah, Talkspace is announcing these partnerships with companies, with municipalities, with uh, like organizations, and they are providing these mental health services, like they are increasing people's access to mental health um, services. So let's look at the other news as well. So this is from 2025 in 28 July. So this is the same news. um, mm, mm. So it becomes the first behavioral health provider to integrate with Amazon Pharmacy, offering psychiatry services and more seamless medication management experience. So it is partnering with Amazon Pharmacy and with Amazon itself as well. Um, so Navigate drives continued momentum in its partner ecosystem. So this company called Navigate is partnering with Talkspace to provide mental health services. Mm, so it expands virtual therapy access to Arizona's 1 million plus Medicare members, right? So they are expanding in Arizona. They are expanding in a lot of states now. City of Memphis, let's see. City of Memphis extends partnership with Talkspace for fifth consecutive year to provide free mental health services to its 1,000 employees. You see, guys, so a lot of municipalities. You can just Google this information, right? You don't need to be like super investor to know this fact. Just Google like what is the trend of municipalities um, expenditure on mental health services, and you will see the deal here, like how much of municipalities are expanding to provide these mental health services. And now Talkspace is going out and partnering with them, and they are the go-to service provider for these mental health services, right? So they are generating a lot of revenue from these municipalities as well, and corporations. uh, and, so let's look at it here. So to work in NYC. So Talkspace and American Federation of Teachers. So this is an organization, right? So they are providing these mental health services to the teachers to enhance mental health support for educators, healthcare, and public workers, right? So there's a lot of news. This is from 2024. You can just go to their investor relation page and just watch, like look at all the news that is out there, and their partnership is just crazy. So Talkspace is literally saying, let's not be stupid, right? Let's not charge customers a lot for mental health therapies. There's a better way to do it. Let's make it accessible. Like, let's make it virtual. Let's make it online. Let's save consumers time and money. And let's provide this therapy by their insurance company instead of out of pocket. That way, it will lead to get greater adoption because people are more likely to use um, the mental health service, like if it is affordable, right? And if they can do it from their home. So so it is leading to greater adoption of the service overall, I think. I don't think that because I could think that, but the numbers are telling that it is what it is happening. So if we look at the industry trend in 2025, so digital mental health market was around $24.44 billion in 2032. It will be growing at a CAGR of 18.8%, almost 19%, and it will be valued at around 82.7 billion. So this is according to research and markets.com. It is sad to see this, guys, but I think mental health issues are, like these are like, there's two way to look into this. Like, there's increased awareness why people are using these mental health services more and more. There is reduced dogma and there is increased accessibility on one end, but on the other end, a lot of teenagers are having these mental health issues due to this social media and this online world that we are growing. So this market is predicted to grow a lot in coming years, and Talkspace is a major player. So if we so let's look at the competitive landscape. So Talkspace is not alone in this online mental health therapy space, and there are other platforms, right, which are offering counseling and psychiatry. So the key rivals, one of the key rival is BetterHelp, which is owned by Teladoc, and um, it trades under the ticker symbol TDOC, like I have mentioned before. But there are like private companies as well, like Brightside Health, Spring Health, and Talkiatry. So earlier, BetterHelp used to be, and you could still tell that, you could still say that BetterHelp is one of the largest player. However, so now Talkspace is eating BetterHelp's market share. Like, I got this information from one of the AI, large language model. You can use this information. So I just gave a prompt, and it just analyzed the competitors, and Talkspace has the strongest pricing power. It has the um, solid, or it has the best product strength. Its scale is medium, but its moat is high. Peer contracts and employer partnerships create sticky revenue. Clearly wins on business to business, which is the payer model. But if we look at Better Health, weak. Its pricing power is weak. Its product strength is broad. It provides a lot of services compared to Talkspace. Its scale is large. It used to be large, I would say, but still the the AI is giving it as large. And okay, I would consider it large. Like, I would consider it, because it used to have a massive user base via ads, because BetterHelp spends a lot of money on ads. And moat is low now, because their brand is via marketing, right, and easy to switch and loses to Talkspace contracts. So now more and more of these contracts that BetterHelp used to have are now going to Talkspace. So Brightside, Spring Health, and Talkiatry, so these are other competitors. I think among them all, I think Spring Health has a lot of pricing power, a lot of product strength, although it is private. But Talkspace is one of the major player among all these competitors, right? So yeah, this is the competitive landscape in this business scenario. So let's compare Talkspace versus BetterHelp. I just looked up online and online reviews, and Talkspace has an online review of 4.5 in Trustpilot. So you can see the score here, and BetterHelp, not too bad, like 4.1, but still less than Talkspace, right? Um, but there's a major difference between Talkspace and BetterHelp. BetterHelp's review is not too bad. However, Talkspace is rapidly eating its market share, since Talkspace now provides mental health therapy services, which is covered by payers or insurance companies, right? So why would a consumer bother to pay out of pocket money to BetterHelp, um, if his or her health insurance covers for the service, right? They would just use their insurance that their employer is giving them, and just use Talkspace's platform instead of going with BetterHelp. It makes a lot of common sense from the consumer side. So Talkspace is eating BetterHelp's market share. So let's look at the management team and the insider alignment as well. I think it is a really crucial factor sometimes that we tend to ignore in while investing in companies. So I especially look at all the management, not only the CEO but also the chief financial officer, technology officer, and other directors of the company as well, just to make sure that the company's management is reputable. So it is run by so the CEO currently is Dr. John R. Cohen. He is not a, uh therapist by training, right? So he used to be a vascular surgeon, but he has a lot of experience in this government space, this running the companies, and like you can read it all online, but you can just stop or screenshot this and just read it, give it a read, right? He is a really really great businessman. He knows how to execute, when to execute, and which direction to execute to improve the company, or just move the company in the right direction. So not only the CEO but the technology experts who are behind Talkspace are have proved themselves in the past. So I like this management. Looking at the insider alignment, like if they are aligned or not. So there's a few interesting purchases. So in 2025 February, so the CEO purchased $75,000, 75,000 stocks, a price of 2.86. This is basically at the same price. I think I invested in this company and increased his position in the company by 3%. So now he has around $2.2 million, 2.2 million stocks, right? So he spent around $200,000. The chief financial officer, he also made a purchase of 30,000 shares at around $2.79, and now he has around 600,000 shares. So and they, since their purchase, they haven't sold, like they haven't sold their stocks. So there's a good um, management alignment. Like although this is about in like around 9 months ago, they thought that the company was trading at a cheap price at around $2.8, so they made the purchase. um, so there's some sales from CTO, technology officer. He or she has like done exercise the options as well, but other than that you don't see major sell, like you don't see that like investors, like insiders sell for all different sorts of reasons, right? But they only buy it for a single reason. This is when they think that the company is undervalued. So both CEO and CFO bought the company's shares recently, spending their own money out of pocket. So I think we says that the company's management is aligned with the stock's performance. Insider ownership, I took this information from Yahoo Finance. You will get like different metrics from different platforms, but this is free, and I use this. So as of January 2, you can see 4.31% of shares is held by all the insiders, which is not great. I would like to see more of the insider ownership, but institutional ownership is quite significant, 61.55%, and it is um, increasing in the past quarters. If you look at their SEC filings, you can see that. So yeah, insider ownership. I think the management and the insiders are aligned well with the company's performance. So let's look at the risks. There are some risks associated with the company. There could be a risk of consumer concentration. So if they rely too much on one big insurance company as a payer, what if the company decides not to have partnership with um, Talkspace in the future? So right. So if let's say majority of their revenue comes from United Health, and what if United Health just says that we don't want to partner with you, we will go with some other company, then it could cause a major revenue hit for Talkspace. So they have this arrangement with, let's say, Amazon. Right now they are providing this mental health service to Amazon employees. So what if in the future Amazon decides not to use Talkspace, and like what if majority of the revenue is coming from Amazon, right? So we would need to look into this like in detail, and just to figure out that they don't have this consumer concentration within one or two big companies, right? This could be a major risk, I think. So before investing, you would need to dig deeper, look into their um, annual report, and see their consumer concentration. Competition, I haven't looked into this. um, I won't lie to you, but I will look into this more. And I don't think there's a consumer consideration as of now, because they are just expanding their partnerships with a lot of companies. So competition erodes the market share. What if their competition erodes the market share, right? Like, what if their rivals like BetterHelp or Spring Health eat away their market? That could be another major risk. Margin erosion. What if they cannot improve their margins? At one point they would need to improve their margins. Like, they have been improving, but all the margins. Cash burn, they are burning a lot of cash, but what if they burn a lot of cash without any results, right? Execution risk. Like, if they are acquiring other companies like Visto Health recently, what if their M&A acquisitions do not give the revenue that they need, right? Or there's missteps from management. So that could be another risk. That is, these kind of risks are associated with all other companies. What if their business to business model fails? As of now, it hasn't failed, but who knows, right? Nobody can predict the future. uh, what if in the future the business to business model doesn't work out? It could seriously impact their company's future, I think. And there is regulatory risk as well, like AI risk. General large language models as of now are considered dangerous for mental health. I think there's already news in mainstream media saying that people have died using large language models for mental health therapy sessions. Um, what if there is a new FDA or FTC regulation on use of AI in mental health space, right? So I think so. I need to clarify these risks. I think um, uh, I think using AI in mental health space is a double-edged sword for talk space, right? I think using LLMs or AI for mental health service is pretty bad idea. Like, it's not human; they don't know the psychology. It's the machine doing the talk to you, and like, people have died already. But what Talkspace is doing is, like, they are using these chatbots to provide you with podcast, but they are not, these LLMs are not providing the therapy sessions. It is still the people providing you with mental therapy sessions, but they are using AI in this constructive way to provide you with better service. So for Talkspace, it is a double-edged sword, because they can utilize these large language models in their favor to provide better service to the consumers, right? So, and it is a regulated industry, and they are regulated. So they wouldn't be stupid to use AI or chatbots to provide mental health sort of service to the consumers, right? So yeah, these are the key risks, so you would need to look into this. And I don't like, personally, I don't think there's a consumer concentration risk, which could be a major issue like for Rockwell Medical, right? But because they haven't generated revenue from a single, I haven't looked into the details, but I'm looking at the news and the agreements they have done. I don't think there's a major customer as of now, but in the future, if they have this major customer who is making all these payments and generating most of their revenue, it could be a consumer concentration risk in the future. um, so let's talk about Rockwell Medical. Like, I got an email from one of the investor who looked at the past video and was asking me questions like, "Oh, you said that Rockwell Medical would announce a partnership by the end of 2025, and they still haven't announced." So first of all, like, I always ask you to do your own due diligence, right? So I agree that the company still hasn't announced any major deal with new customer, but there's a lot of spaces or a lot of platforms that you can look into how the company is doing in these current times, right? So I went to Rockwell Medical's LinkedIn page, and I looked into their insights. So job openings growth in 3 months, in operations it is 133%, in support it's 200%. So in total it's 200%. And in 6 months period it's 900%. So look at that, guys. So the company is hiring crazy compared to the size of their employees. So they are doing a lot of hiring right now. And you see there are 9 jobs that are open as of now, and you can see customer care representative in Grapevine, in Wixom, in Santa Ana, California, interesting, Illinois, Arizona. So what this is telling me is Rockwell Medical is expanding in the West, guys. Why would they hire a driver in California if they are not expanding in the West? And what if they, well, why would they hire a driver in Arizona, right? And why would they hire a customer care representative if they are not expanding? So I think, although the company still hasn't made an announcement, I think Rockwell is already in progress. I don't know when the news will be announced, but I think Rockwell will make an announcement soon about its partnerships in the West, which the management has constantly been saying that it is 100 million market, I believe. Like it's millions of dollars, right? So I think the company is still making progress in the right direction. I've been patient with the company. My investment is down a lot, but I think Rockwell Medical will do exceptionally well in the future. But this is my personal thesis or personal opinion, right? Like no matter where you decide to invest, I always ask you guys to do your own due diligence. There are some things that I could miss, um, that you need to look into carefully before investing in any company, and that way you lower your risk. Nobody can predict the future, but you can lower your risk with your due diligence. So going back into Talkspace is a buy for me at these current prices, especially looking at their price to earning growth ratio. But me personally, I bought the company at 2.8 dollars. It is currently trading around $3.5. So if I were to invest right now, I would wait until the stock price comes down to around $3, let's say, or 3.2, right? Just so that I get a better value. So thank you. And this is Rational Investing 101, investing based on rational decisions, not hype. So don't forget to like, subscribe, and hit that bell icon, guys. Your support means a lot to me. Thank you, and I appreciate it. Just let me know if you have any um, ideas you can put down in the comment section below. Thank you.